First of all, I'd like to thank everyone for joining us this afternoon to a webinar talking about life settlements. And we have with us Tony Bremness from Laureola Advisers. Probably fair to say that life settlements isn't a very well-known strategy in Australia. But certainly it's the only life settlements fund on the fund monitors database out of 500 funds. So it's relatively unknown. We've known Tony for a while. We've been discussing things with Tony for a number of years, since I had the pleasure of seeing him actually in the south of France. And Tony has now launched a fund in Australia, so a feeder fund for life settlements. Rather than listen to me talk about it, we might say hello to Tony. Welcome to Fund Monitors.
Thank you very much, Chris. Thank you for having me. Thanks very much for having me.
It's our pleasure. I suppose we start off by asking you exactly what life settlements are, how does it work, and then we'll go through some of the benefits and key parts of the strategy. But if you could just give us an introduction into life settlements.
It'll be my pleasure. I'd like to share my screen and show just a few slides that may help the description be a bit more understandable. What are life settlements? Are we seeing that slide?
Yes, we are.
And let me.
May go to
here we go.
Screen mode.
Okay, so life settlements. In the United States, it is both legal and, in fact, encouraged by the government to sell your life insurance policy if you no longer want it or no longer need it. That's been enshrined in law by a Supreme Court decision that goes back to 1911. So the legal basis of life settlements has been around for a long time. The industry, or the asset class, if you will, it really took off or started to gain traction during the AIDS crisis in the 1980s, where the poor people suffering from AIDS had, in the United States particularly, had a very expensive treatment that eventually became available. And to pay for that, they had to sell something, and they sold their life insurance policies. And the industry has moved on quite a lot since then. It's now much more highly regulated. There's a lot of protections that have been put into place to protect the seller, to make sure he gets a fair price, to make sure he understands all the rights that he's giving up, and to make sure he understands all his rights under the contract. These things are not securities, life settlements. So each transaction is a private transaction that has to be notarized, and it's a lengthy contract and highly regulated. And both the buyer and the seller profit. These things trade right now in the life settlement market, a life insurance policy, with an IRR, internal rate of return, which is roughly the equivalent of the yield, somewhere between 12 and 16%. So we can buy it at a 12 and generate a gross 12 to 16% return for our investors if we get everything right. But the buyer also profits, because the only reference point that the buyer has for the value of his policy is how much surrender value he'll get at the life insurance company. And sometimes the surrender value is near zero. Sometimes it is zero. And even when there is a surrender value, the life settlement buyers, such as Laureola, will typically pay between 3 and 4 times what the life insurance company will pay. So that's how both the buyer and the seller profit. And of course, in every transaction, there has to be somebody who loses. And in our transactions, it's actually the life insurance company that loses. And I'll explain why on the next slide. If you think of life settlements now from the point of view of the investor, such as Laureola, this is a stylized diagram of the cash flows. Of course, we pay the investor cash for his policy. That's this blue lump down here. That's a negative cash flow. We have to pay typically 20 to 30%, of the death benefit. So if the death benefit would be $1 million, we typically pay 200 to 300,000. So the insured benefits, because his surrender value is probably only about 50 or 60,000. So he talks to the insurance company. They say, we'll give you 60. He comes and talks to Laureola or other buyers. We'll say, we'll give you 150. He can't believe it. He thinks it's a great deal for him. And in a way it is. The rest of the cash flows are, most of the rest of the cash flows are also negative. These red bars here represent the premiums to keep the policy in force. Of course, the investor must pay the premiums. The insured is no longer responsible. It's the investor that has to pay the premiums. And eventually, when the insured passes away, what we euphemistically refer to as the policy maturing, then the cash comes back in, and that's the death benefit. The insurance companies pay the death benefit, and they pay that to the fund. So you can see a couple of things right off the bat. You can see where the arbitrage is, because our job, of course, as investment managers is to make sure that this first outgoing of cash plus all the red bars, the premiums, come to a lot less than this blue cash that comes in, this blue bar at the end. And that's, and we can calculate that. We have the software that does that. So on the purchase, we already know what the gross IRR is. Now, from the point of view of the insurance company, I mentioned earlier that they were the loser in this transaction. And the reason they're the loser is because, and insurance companies don't tell you this, but what the insurance company wants is that the investor or the owner continues to pay these red bars, the premiums, and then he runs out of money, or he for whatever reason, he stops paying the premium, and then the insurance company never has to pay the death benefit, this blue bar at the end. And it's an amazing statistic. It's probably the most important piece of information I'll give you today, is that in the United States, 85% of the time, the insureds let their policy lapse. They stop paying the premium, and the insurance company never has to pay the death benefit. It collects all the premiums and never has to pay anything out. And it's an amazing statistic that happens in over 85% of the time. And that's the first arbitrage that we take advantage of as investment managers in life settlements. The insurance companies, they are effectively in the United States selling life insurance at a loss. They price their life insurance on the basis that the vast majority of people will never collect the death benefits. And we essentially piggyback on their model. When we buy the policy, we are going to pay the premiums and keep the policy in force until the day the person dies, and we collect the death benefit. Now, the other part of our job as the investment managers is to make sure that we understand the mortality profile, which means how long the person's going to live and how long between the time between we buy the policy and the time we collect the death benefit, the time between those two blue bars. And the longer the person lives, the more red bars there are in between, the more premiums you have to pay, obviously, on a monthly or sometimes annual basis. And of course, the longer you wait for the cash flow to come back in. So that's our number one job, is to make sure that the assumptions that go into the calculation of the internal rate of return are correct. And that's all about studying the mortality profile of the insured. Now, there is a second arbitrage that we're able to take advantage of as investors in life settlements. And that is the life insurance companies, for obvious reasons, like to insure healthy people, because the healthy people live a long time. There's a lot more of those red bars. The premiums come in, and then maybe they run out of money. They usually do, and they let the policy lapse, and there's no death benefit. But the one thing the life insurance company won't do is, if you're quite ill, they won't insure you. Simple as that, because they don't want to pay the death benefit in the next few years. But if a healthy person buys his life insurance policy while he's healthy, he then gets the premiums that have been calculated by the insurance company on the basis of him being healthy and living a long time. And when we buy policies, we focus on people who are ill, what we call impaired lives. That may be some kind of cancer, heart problems, liver, lung. Of course, more and more we're seeing Alzheimer's and dementia. But we want to buy people who are unhealthy. We want to buy policies from insureds that are unhealthy for the exact opposite reason that the life insurance company doesn't want to issue them. But the life insurance company is trapped because a life insurance contract is a contract, and they're not allowed to change the premium stream just because the guy got unhealthy. So we're able to buy life insurance contracts whose premiums are based on the person being healthy, when in fact his health has changed and he's very unhealthy. So those are the two main arbitrages that we're able to take advantage of in the life insurance world. Let me just give you a few more statistics about the market, just to give you a sense for the whole asset class, if I may. The total amount of life insurance outstanding in the United States today is roughly $17 to $20 trillion. So that's the same size roughly as the stock market or the GDP of the United States. It's a huge amount. And the life settlements, which is the market for insurers that want to sell their policy to investors, the life settlement market has taken in its entire existence less than 1% of that 17 trillion. So there's all kinds of room for growth. There's all kinds of policies out there that people don't want. And as the education in the United States grows, that they have the option of selling it, we expect the supply, there should be a steady and consistent growth of supply, which of course benefits us as investors. The life settlement market itself is divided into two segments. The first segment we call secondary in the jargon of our asset class, and that's when we buy the policy directly from the insured. There's a second segment to the life settlement market where one investor, for whatever reason, decides to sell the policy on to another investor, and that's perfectly legal as well. And that's called the tertiary market. Of course, there is no tertiary market unless there's a secondary market and somebody's buying them from the insured. To give you a feeling for the size of the market, the secondary market trades about 70 million of capital a month, or about 850 million a year. And Apple stock, which I'm sure you know, does 10 times that in a day. So we're a very small, very boutique market, which is part of the reason, as Chris mentioned earlier, that not a lot of people have heard of it. Even in the United States, a lot of people haven't heard of it. In Europe, very few people have heard of it. And so it's the same story, of course, in Australia and in all countries around the world. Very few people know this asset class, which means there's still opportunities out there for investors. Because capital, of course, always destroys the returns. The more capital that pours in to any asset class, the returns go down. It's just mathematical. And there hasn't been a lot of particularly the big capital come into our asset class, and that's good. So that helps protect the returns. It's a very labor-intensive asset class to manage. If you manage a stock portfolio, for example, and you have a 10 million portfolio and you bought all your stocks, and somebody gives you another million or another 5 million, you go out and buy the same stocks. You don't have to do any more work, and you can do it at the push of a button. In life settlements, you have to go out and find new policies from people who want to sell them, and you have to do all the analysis work policy by policy, because no two policies are the same and no two insureds are the same. So it's a bit more labor intensive, and there are, of course, capacity constraints. So we've committed to capping our fund at around about the $150 million US level, and we're currently at about 65. And that's to make sure that we can always generate above average returns. If you know the investment industry at all, and you think of the big players, for example, in the United States, the Goldman Sachs and the Morgan Stanleys, they won't even think about a fund that's only going to go to 150 million. They won't, as the fashion model said, they won't even get out of bed for less than 200 million to start the fund. So the fact that this is a small boutique asset class really favors smaller players like ourselves, and it favors the insureds in the sense that there's a lot of barriers to entry to keep the biggest players out, and that, I believe, helps protect the returns. Apologies, that was a very lengthy introduction, but I hope it was informative.
Thank you, Tony. That was very informative. We'll have some questions afterwards, but as I understand it, one of the greatest advantages of this as a strategy, whether it's Laureola or anyone else, is that it's completely uncorrelated to financial markets. And given the volatility in financial markets, particularly this year, that would seem to be one of the big benefits. So what sort of returns are you getting, and how steady or unvolatile have they been?
Well, thanks, Chris. I think that's a very good point. Our returns historically have been here. I'll show you those in just a minute, but the non-correlation may be the most attractive aspect of the asset class, because that really is the holy grail in the investment world. It's one of the few things that actually works as well in practice as it does in theory. If you can find an asset class that even generates the same returns as you're getting already, but will do it in a different way, boy, you need some of that in your portfolio, if it is genuinely non-correlated. And so many alternative investments have promised non-correlation, but not delivered when things go down. And life settlements, if it's done properly, will deliver returns. We can make money when others don't, for the simple reason that we make money, or the amount of money we make depends on whether or not the people die. It's mortality. And that is not going to be affected by the stock market, by the interest rates, by geopolitical events, or even by the economy. In fact, if we are affected mildly by the economy, but in a positive or in a reverse way, by that I mean, if the economy gets difficult in the United States, which is the case right now, more people have to sell their policies. That's good for us. So we're mildly negatively correlated to the economy because it helps us with the supply. But overall, we have no connection at all in terms of how we generate our cash returns. We have no connection at all to these other markets. And for those of you that like the numbers, there's the correlations. This is our fund that's been in existence for over 7 years, and that's the correlations with the major indices. The Barclay Hedge, you want to see these numbers as close to zero as possible. Barclay Hedge, we've got very little negligible correlation with other hedge fund managers, with other alternatives, similarly with the equity indices and the bonds. And in terms of dollars and cents, you can see, I use the S&P as a proxy for the traditional markets, the stock markets. In the 10 worst months for the stock markets, we were positive in most of them, had a very small loss here in January 15, and a slightly larger, minus 5% in that, but that was completely coincidental. And I could talk about that in the questions if people have an interest, because it's important to understand the risks, and you can often do that visiting the negative months. But overall, if you take all the returns we did in all these negative months and the returns of the stocks in these negative months, we were probably up about 4 or 5%, and the stocks were down minus 30. And that's what correlation does for you. Non-correlation does for you in practice. A portfolio of life settlements, not one individual life settlement, but a portfolio of life settlements, and we have 170 in this portfolio, should generate a stable, consistent return, not necessarily on a monthly basis, but certainly on an annual basis or on a 3 to 5 year basis. We believe the best, in fact, the required time horizon to make good money in life settlements and to enjoy the non-correlation, the right time horizon should be 3 to 5 years. And so we ask for the money for 3 years in our fund, and that's the basis for it. But there's the numbers. You can see by the graph, it's been reasonably steady on an upward slope. You should be very suspicious if the numbers are perfectly consistent month by month, because that means it's probably being done through the accounting. but we should expect consistent numbers annually. We've had positive returns in every calendar year. We've had positive returns in over 90% of the months, although some of the months have been very quiet. When, as they say, nobody dies, of course, there's no profit coming in or very little profit. And hence we've had quite a number of months that have been 0.1, 0.2, 0.3, where not much is happening. But on an annual basis, we've typically hit high single digits or low double digits. In earlier years, the fund was quite small and the markets were different. We were able to do in the high teens or perhaps the low 20s. But we suggest the expectation with today's market and life settlements should be somewhere between the 8 to 12% range, but steady. And we should be able to deliver that regardless of the stock market gyrations or any increase in interest rates.
Tony, a couple of things there. You mentioned you take some questions later, but there's that figure in December 2018, which is somewhat of an aberration. I mean, everything is steady, positive returns. Can you just explain that December, if it's simple to explain, December 2018?
Yes, of course. It's as you might imagine, it wasn't exactly our favorite month out of the last 65 or so, but it's actually a month that investors should pay attention to when they're looking at life settlement funds. And I'll try and explain. I mentioned earlier that one of the key assumptions in the pricing of a life settlement is the mortality or the life expectancy. Because obviously, you'll pay more for someone who's likely to die in 5 years, he has a 5-year life expectancy, than you will for somebody who has a 10-year life expectancy. I mean, if you think of the mathematics from that earlier diagram, I think you can understand that. So the life expectancy quite dramatically affects the value of any life settlement or any life insurance policy. Now, in November of that year, 2018, there was 2 leading life expectancy underwriters, and their names were AVS and 21st Services. And they came out and announced in November that the life expectancies they'd been providing investors for the past 3 or 4 years were wrong. And they were wrong in that they were too short, and that the more accurate life expectancies would be longer. And that was true across virtually all the life expectancies that they provided. Now, AVS and 21st had underwritten or provided a life expectancy opinion on over 90% of the policies that had ever traded in the life settlement market. They dominated the market. So it was an industry-wide event, and there was no such thing as a portfolio of any size that wasn't affected by that. We were less affected than some and more affected than others. We were less affected than some because we'd already started to move away from those 2 life expectancy providers, and only about a third of our portfolio was affected. But when that announcement was made, the professionals who value the policies for our fund, because of course we don't do it ourselves, we have to get a professional actuary to do it. Their name is Lewis and Ellis in the United States. They came to us and said, we can't do a December year end with valuations that are based on life expectancies that are known to be wrong. And so you have to get out there and get new life expectancies. And in the cases where you can't get new life expectancies, we will manually make the average adjustment to life expectancies, which was about 10%. So if an individual had a 60-month life expectancy in November, he had a 66-month in December. And of course, that brought down the value of the policies, a third of the policies in our portfolio, and it produced almost a minus 5% month, which is, does stick out because that's a very unusual, a very high negative number for life settlements. And it does indicate that there was something wrong in the valuations, which there was, because we were using life expectancies that were inaccurate. Now, this is not a realized loss, this is an accounting loss. So investors that came in after that, of course, were able to buy in policies at a lower price when they invested in our funds. So it was good for the investors that came in after, but it wasn't very good for the investors who came in just before and saw a minus 5% month to start with. And, I'll be quite honest with you, they were screaming bloody murder, and I don't blame them, really. It was something, the key points are, it was something that affected all portfolios. It was something that was to some degree out of our control, but it was nevertheless our responsibility. And so the next question is, well, what did you do about it? So to make sure it doesn't happen again. And so our approach was twofold. It was a wake-up call that we can't, as a professional asset manager, you can't trust the life expectancies that even the best life expectancy underwriters are giving you. You have to have a backup plan. So we took two major steps. The first was that we redid and much deeper our due diligence on the life expectancy underwriters. And we now know which ones we can trust more often, which ones we can trust less often. We know which ones are good in particular ailments, which ones aren't so good for those ailments. We know which ones tend to be typically short than they should be, and other ones that are typically long. So we have a much better understanding of which life expectancy underwriters we can trust and which ones we should use. And no surprise, we've been moving away from AVS and 21st. The second thing that we did was, and I'd already started this, in fact, is Laureola's put together an advisory board, which is made up of medical and scientific experts. And when we get a policy that's where we're not comfortable with the life expectancy, or a policy that's very complicated in the medical records, or a policy that's very large and hence represents a large part of the portfolio, in all those cases, we will send it to one of these medical or scientific experts, and they will send us back a report. And that report would include an analysis of all the studies that were done with people with a similar ailment. So for example, if it's a lung cancer, the report will include all the studies that were done where they took people, 300 people or 500 people that had lung cancer, and they studied how long they lived and the whole mortality of people that have that ailment, the whole mortality curve. And so when we get these back, it's not that we're asking the panelists to tell us when the person's going to die exactly. Nobody can do that. But we're asking the panelists to make sure that the life expectancy we're using to buy the policy or to value the policy is reasonably accurate, i.e. it has the insured has a good probability of dying at or before that life expectancy. So we've taken these two steps. They've been very time consuming. They're quite expensive. But we've done, we believe, what's necessary to avoid that happening again. I should point out that on a case-by-case basis, individual policies, there'll always be some that go beyond their life expectancy, because a life expectancy is really the average for people who have that kind of profile, for people that have the same age, the same ailments, and et cetera, the same family history. A life expectancy of 60 months does not mean you expect the person to die in 60 months. It means half the people will die in the first 60 months, half the people that are like him, exact same profile, half in the first 60 months and half after. So our job is to make sure, more often than not, our guy is in the first half rather than the second half. But there's no such thing as a portfolio where you get it 100% right. So even if we hit 50-50, we will achieve our projected IRR on the purchase, which, as I mentioned earlier, was somewhere around 12 to 16%. If we get the 50-50. And most investors and even most life expectancy underwriters do not get that 50-50. It can be measured by the actuary, And in fact, in 2018 and parts of 2019, we weren't getting 50-50, which is another reason that that I accelerated this whole building of the advisory board to get us back to that 50-50 level. And the fact that we weren't getting 50-50, with half our people dying when they should have and the other half going a bit later, that shows up in the numbers for 2018, 2019, because we weren't getting quite the level of mortality that we should have. But that now, according to the latest study, which the actuary did in June of this year, that number is getting back very close to 50-50. So there's some positive results from the study from the actuary, but I've tried to describe that in some length, because getting the mortality right is your number one job. It's the most important factor that determines the performance. You must get the mortality right. In the early years, we were getting it right. 2018, 2019, not quite right, not disastrous, but not quite where it should be. But since about mid-2019, we've been back on track. Now, bear in mind that a year in actuarial terms is a very short period of time in terms of your mortality, understanding and analyzing the mortality. The actuaries, like all statisticians, they always want more and more and more data and longer time frames, but we have to work with what we've got. And from the data and the study that the actuaries have done, that does look like it's turning around. And finally, I'd like to say just one last point on that minus 4.9, and then I hope to get off the topic as quick as we can, because there's been a lot of other good months, of course. But there was a superannuation fund in New Zealand, if I'm not mistaken, that had quite a large portfolio of life settlements that was managed by two large companies, highly respected. The two companies were Apollo, which is, I believe, a large private equity firm out of the United States. The second was Credit Suisse. And that portfolio had a minus 25% month in December. So we did better than them. But there's been other funds that have posted a negative month, but a smaller negative than ours. So it could be down to a number of factors. Perhaps they were better prepared, or perhaps they value it differently. No two funds value their policies in exactly the same way. But there's been other funds. We have some competitors that didn't recognize that impairment to the value of their policies at all. They just pretended it didn't happen and kept posted a positive month and kept on going. And so from that point of view, the returns on that month for investors are a shortcut for the investors to understand whether the manager is being responsible in marking the portfolio with the latest life expectancies. Because I'd suggest to you that anybody that didn't have a negative month there is just not valuing the policies accurately, because it affected everybody. Sorry, Chris, I've gone on again, but I hope that's helpful.
No, that was good. I'm sorry to have dragged you down a rabbit hole on a minus 4.9%, because no one likes talking about those. But I think it's always important, if you've got a standout result like that, whether it's minus or positive, that there's an explanation for it. So thank you for your frankness on the explanation. We might. Unless you've got another slide or more things you want to say about this, I mean, we might throw this open to questions. The one comment I'd make is that when I first met you and heard about the strategy, I thought this was a bit morbid and macabre, really, that you're doing this. But what came through very strongly was what you're doing is actually helping people who either can't afford to maintain their policy or are possibly sick or need the money, and you're giving them a much better deal than the insurance company would. I don't think insurance companies have a fantastic reputation around the world for being particularly kind. We won't go there right at the moment, because there's a lot of publicity about a large insurance company in Australia who's in the news at the moment. But I think that's a really important aspect of it, that you're actually benefiting, and I think it was in the slide earlier, both parties win. The person who's selling you the policy wins because they get the capital they need for whatever reason they need it. And it's just a different way of looking at it. I might throw this open to questions. If anyone has any questions.
Chris, it's Damon here. There's actually a couple of questions on that have been written down. Stefano asked, Tony, catastrophe bonds have an index that reflects to some extent how the investment performs, as in cat bond managers will outperform or underperform the index. Is there something equivalent for life settlements? Or if not, is there a median manager index reflecting the performance of managers like Laureola?
There have been people that have tried to put together an index for life settlements, but I wouldn't recommend referring to it. And I wouldn't recommend referring to it because each open-ended fund values the policies differently, and sometimes there's a huge discrepancy. So we know of a couple of our competitors, for example, that are valuing their policies using a discount rate of between 10 and 11% to discount the future cash flows. And we think that's very aggressive, and we think it's going to end up with a valuation that they can't resell into the market anywhere near that. We use 14% just for comparison. And if you think of our $60 million portfolio, if they had to change from that 10% to our 14%, that could easily be a difference of 25% to the value. I mean, it's huge. So you're just not, when you're comparing, it's a crazy asset class, but when you're comparing different funds, you're not comparing apples to apples. You have to look in to how they value it. So, and that's not us trying to get out of a measuring stick. It's important to have some kind of measuring stick. I appreciate that, but most of these funds, the returns have to be taken with a grain of salt because often it's in the valuation. But let me suggest some numbers that some numbers that may be helpful. We would argue that the beta, if you will, or the index equivalent, that the average return in life settlements right now, certainly from a fund point of view, is around 6%, 5 to 6%. We come to that number through two different ways. One, the policies are trading somewhere around the 12% level if you're going in any size. And if you take the fund costs off that, and you take the management fees off that, and the manager may have a performance fee, and you would also add on the fact that the life expectancies in general are not accurate. They're too short, so not everybody dies when they're supposed to. You add all that in, even a well-managed fund of size will deliver about 5 to 6%. And there is one extremely large fund, large by life settlement standards, in the United States that's run by a company called VIDA, V-I-D-A, out of Texas. And their returns in the last 3 years have been at the 5% range. Not quite that this year. I think they've had some difficulties this year. But those two things together suggest to me, at least, that the average or the index for a reasonably well-managed fund should be somewhere around 5 to 6%. So we think we can do a little bit better than that because of our efforts to get the mortality better. And because of the fact that we're not so big that we have to take every policy we see, so we can pick and choose. We pass on as many policies as we buy. And if we're good managers and we can pick the better ones, both in terms of the mortality and the pricing, then it's quite easy to come out in the 8 to 12% range. Quite easy because the market is very inefficient, unlike stocks or real estates that are reasonably efficient markets. Even though sometimes you wonder, but in terms of their transparency and the information being out there, you can't get the information you want. But in life settlements, it's very tough. And we can often grab policies quickly before our competitors even see them or have a chance to bid on them. So that's an advantage too that comes from being small. So all our advantages put together, we think we can lift ourselves from the 5 or 6% up to the 8 to 12%. But sorry, the short answer, there is no index, and there's an index out there that's run by AA partners, but people don't trust it. They don't know what goes into it, and they don't know how it's calculated. But besides that, there's nothing. It's just very, very difficult to do in-life settlements, unfortunately.
Thanks, Tony. Damon, any other questions? I can't see the questions on my screen. Can you see?
There was a couple of questions that came in earlier regarding the performance after 2018, which I think had been largely answered. Anyone who wants to ask a question, if you just hit the raise hand button on your browser, I can let you in. If anyone's got any questions.
I see that Stefano raised his hand.
Stefano?
Yes, thank you. Thank you for this. It was really, really helpful, and I enjoyed it very thoroughly. Do you have, and I know I'm putting you on the spot, do you have a slide for how you arrive at the 6% number? I mean, I take your expertise. I'm not really questioning it. But in terms of dialogue for me with my colleagues, that would be phenomenally useful, just to be able to, kind of say how you come to that 6% number exactly.
I don't have a slide on it, but I'll make myself a note here, and I will produce one and send it to you. But really, we look to VIDA because they're recognized as a well-managed fund. They've been around for a long time, but they're so huge in the life settlement world. You remember my statistics about the market. They've got a $4 billion fund. That's the equivalent of a $4 trillion fund in equity. So if you're $4 trillion in equities, you're the market. And that's the numbers that they've been generating. And it's interesting that they've come to a similar conclusion that we came to. And they've been putting a lot of resources into understanding the mortality better. They fired AVS. They were doing all kinds of business with AVS, and they fired them after 2018. So that tells you something. And I'll be honest, they would have had a lot more resources to look into it than we did. But they fired them, and they went out and they didn't put together an advisory board. They bought a whole company, because if you're that size, you can buy the whole company. That studied mortality. So they've come along they've come down a similar path to us, obviously with a different size. But my point I'm trying to make is they're well recognized as a well managed fund, and they're only able to do 5 to 6%. So that suggests to me that that's as good a number as we can find for that type of index-like number, or what the average could be in a well-managed fund. And it does reconcile, with the fact that these things are trading projected IRRs of 12 to 14. That's a gross number. You don't achieve the projected IRR because, of course, there are costs in life settlements, including the fund costs and the manager's cost. And the life expectancies don't always hit where they should. So both those two logical paths lead me to the 5 to 6% number. But I can put that in a slide for you, Stefan. I'll be glad to do that.
Tony, we also got a question from Andrew Stevenson. Andrew, you should be able to chat now.
Yes. Is COVID likely to have any relevance to the numbers?
Yes. Obviously, COVID is a health-related issue. And it, as I'm sure you know, if you studied I'm sure you've looked at the statistics, we all have. The healthy people, even the 50, 60-year-old and earlier, it just doesn't affect the mortality of them. But it does affect the mortality of people in the 70s and 80s and 90s. And it does affect the mortality of people that have what they call pre-existing conditions, what we would call impairments. And well, wouldn't you know it, our portfolio is full of people, 80s and 90s and 70s, that have all kinds of these pre-existing ailments, because those are the type of people that we focus on, and we always have. So yes, it's the COVID has already had an impact on some of our months, and you can pick them out on the bottom line there. July and June we had some maturities, and May we've had some maturities. But at the same time, you have to take it with a bit of a grain of salt, because if a 90-year-old that's not very well, he may have died from COVID-related symptoms, but he wasn't going to live another 10 years anyway, if you know what I mean. At that stage of the game, people can go at any time. So, there's all people, and a lot of people in that category that in the United States that die from the flu every year. But short answer, yes, COVID has definitely changed the mortality profile of virtually all the insureds in our portfolio. That doesn't mean they're all going to die, but it means they all have a slightly higher chance of passing away than they did pre-COVID. And that slightly higher chance of passing away is not reflected in the valuation of the fund, because you can't really factor it in. But it will be reflected, presumably, in the numbers that are coming in the next few months. And in fact, August, we had another maturity, as we call them. A couple of people died, and we should have a reasonably good August as well, probably around the 1% level. So that's average or above average for our fund. So yes, COVID's having a big impact on the health, but it's having a second impact as well, because of all the lockdowns and the measures that have to be taken, that should be taken or have to be taken, and that have obviously have a huge negative impact on the economy in the United States and other countries. That means that people will suffer hardships. Put it quite bluntly, there's over half the population in the United States that doesn't have enough money for next month's expenses, rent or food or anything else. So there's going to be a portion of those, and you could include business owners. A lot of people that own the gyms or the restaurants or the bars and all these hospitality things. They're they got to be suffering. You feel for them. But all these people, there'll be some percentage of them that may need to sell their policy, and of course that helps the supply side. So usually these large geopolitical events don't impact us at all. But of course, COVID being a health-related one, yes, it should have a positive impact on our returns, probably for the next 12 months.
Thanks, Tony. Damon, can you see if there are any other questions?
There was one more question from Grant Mason regarding the investment returns. 2013 to 2017. There was outlier returns and of quite large amounts. He said you briefly touched on that, but maybe you could provide a few more details on why there's those sort of October 2014, June 2013 sort of outlier returns.
Sure. The first 4 years, really through to 2016, the fund was quite small. Probably less than 20 million. And in the earlier years, less than 10 million. In fact, less than 5 million in the first 2 years. So when you have a relatively small denominator and you get a policy that matures, that's even of medium size, a 500,000 policy on a $5 million fund, that's, that could easily be a 5% profit. The same policy that matures today in today's fund would be a 50 basis point profit. So that's the difference there. The denominator was smaller, but the second, and so with a smaller fund, we were able to pick and choose even more. We only got the very best of the best policies in there, and some of them matured early. The actuaries will tell you there's not enough data points in those first 4 years to be conclusive whether it was skill by the managers or luck. So you could decide that for yourself. But please bear in mind what Napoleon said, when he was asked what makes a good general, he says, I want the guy to be lucky. Luck makes a good general. So maybe that's the same with fund managers. But my point is, the actuaries wouldn't come to any conclusion of that, but we think it was at least part skill, and there's always a bit of randomness too, you have to be honest. But we had some very good buys and a very small denominator, and the market was very different. The market was very much tilted towards the buyer. There was very few buyers and a lot of sellers in those first 4 years, and hence we got much better prices. We were buying at IRRs that were in the high 20s and even in the 30s in some cases. So all that factored through into some outlying numbers. But I would make one point with the numbers, is that the months that the gentleman was referring to, particularly in 2015, these were 4 good-sized maturities: February 6%, July 5.9, November 7.3, and December 3.7. So that means that it wasn't based on any accounting. It was based on cash coming back into the fund, which means it may have been luck, but at least it's real. Which is just a huge issue in life settlements. How much of the performance comes from cash and how much from accounting? We're 65% cash since inception, and that's a number that's twice our competitors, because we really focus on the mortality and the realized gains. So that scenario was true up until the end of 2016, roughly. Smaller fund, more favorable market. We were able to pick the very best ones, or the ones we thought were the very best ones. There may have been a bit of luck in some of these early maturities as well. Fast forward ahead to 17, 18, and 19, excuse me, the market started to even out the buyers and sellers. It became more in equilibrium, so the IRRs came down. We're still able to buy quite regularly at above that 12 to 14% average, but we buy more in the 16 to 18 now, rather than the 25 and 30 that we got in the earlier years. That's just the way the market is now. So that's come down, and additionally in 2018 and 19, first half of 19, we did have some difficulty getting the maturities, particularly in our larger policies, where of course where most of the money is. So I believe we fixed that, or certainly addressed that issue, and hence the numbers, we believe the numbers will rebound from this 6, 7, 8% level to more the 8, 10, 12% level.
Thanks, Tony. There's one question which probably going to sort of see us out of time, but from James Waggett, which is a good point. Summarise the cost and benefits of entering via the Australian feeder fund, which you've just set up, versus the master fund in Bermuda.
Here's the terms and conditions. It's the same terms and conditions whether you go through the Bermuda feeder into the master, or whether you go through the Australian feeder into the master. The Bermuda feeder is at $60 million, and hence the costs associated with it, or the expenses, are a lower percentage. They're probably about 10 basis points, I estimate right now, whereas the costs going through the Australian feeder, which is a new fund and hence has we'll probably have less than 50 million for a few years. Those costs have been capped at 0.5, but they probably will be at the 50 basis points annually for 2 or 3 years. The advantage of going through the Australian feeder is that you guys are much more better organized on the compliance side than the rest of the world. I congratulate you on that. The paperwork to go through the Bermuda fund is unbelievable, just unbelievable that you can't do it electronically. The compliance department seems to get bonused on how often they say no, and it can be a real frustrating experience, and there's nothing I can do about that, because you just don't win arguments with the compliance department. You can never get your hands on them, for one thing. And even we have a really good relationships with Apex in Toronto. We've been doing business with them for a long time, but they can't do anything about their compliance department either. So it's it's a more frustrating and lengthy experience to get invested in the Bermuda fund. Both offer the option of an Australian dollar investment hedged. But then the Australian one has Australian service providers as well that will be producing all your documents that you need for year end and that kind of stuff. So convenience certainly on the side of the Australian feeder fund. Costs right now may be slightly tilted towards the Bermuda fund. You can invest in Australian dollars in both. And please bear in mind too that the figures I've been showing you have been US dollar returns for the Australian dollars or any other currency, because in Bermuda we do offer sterling investments. May not be relevant in Australia, sterling, Swiss franc, and euros, as well as the Australian dollar. So all the currencies that are non-US, they're all on a hedged basis, and nobody does the hedging for free. And the hedging costs can be between 1% and 2% per year. But if the Australian dollar moves in your favor, at least at least you'll be hedged. You'll be getting a similar return to US dollars, but still keep the Australian dollar and not have the US dollar exposure.
Thanks, Tony. There's one more question from Andrew Stevenson, but just on that difference between two, the Australian Feeder Fund is also available via Olivia, which might make it easier for people to invest, for those that are familiar.
Yeah, it's my next slide there, that John and I are based in Europe, and if people have questions specifically on the investment side, we'd be happy to help you. But all the performance updates and online applications, we're working with Australian fund managers, and of course they're in the same time zone as our Australian investors, whereas if you talk to us, it's an overnight jobby and all that kind of stuff. So hopefully we've made it convenient and convenient to invest in Laureola through the Australian feeder, and hopefully it's something that Australian investors will consider.
Andrew, I think you have a question. Andrew Stevenson.
Just one question. The numbers quoted, gross or net of fees?
These numbers here are, where did I go? These numbers here are net of all fees, net of performance fees, net of management fees, net of fund costs. If you redeem early, there's a cost. That's not included in there, of course, but if you keep it in for 3 years, that's the returns you'd get. And in some cases, people go through an advisor who charges a fee. That fee's not included in there. But I believe if you go through Olivia, there's no commission charge on that, is there, Chris? So they'll experience these numbers?
No.
Okay. So, yes, net of all fees to the investor.
Thank you.
I can't see any other questions or any hands up on the system. That being the case, Tony, thank you for your time. I know it's early in Europe, but you have the benefit of having a lovely warm day ahead of you in the beautiful Provence. Thank you for your time. For the attendees, we'll be sending out the presentation that Tony has presented, but do you have any other questions, please don't hesitate to ask. Thank you, Tony. That's it for this evening. We'll look forward to seeing the attendees at our next webinar, and we'll look forward to seeing Tony as we go forward in the future to hear more about the performance of the fund as we go forward. Thank you very much for having me, Chris, and thank you to the attendees for their attention. Appreciate it.